with you, 'cause you feel my mind, or you feel my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. Tonight is yours, won't you sing for me? Won't you sing for me? Till we fall asleep. Tonight is yours, won't you sing for me?
Hello, everybody, and welcome to VC Masters, only on the Pod TV network. I'm Alavino. I'll be your moderator for today's show, and we're going to welcome the VC Master himself, who'll be discussing some of the breaking news that you need to know about in the venture capital or alternative investment world, and that's none other than the head of the Azimuth Opportunity Fund and also a professor at Duke University. And you've seen him on the show before, Dr. Salman Azar. Dr. Salman Azar, welcome to your show. So tell our audience, what do we have? What's the latest and greatest news and breaking news in the VC world right now?
Well, I have good news and bad news. What do you want first?
How about the bad news? Let's do the bad news.
All right. I have lots of bad news. So get ready for this. So the software, you sound like Jim Cramer.
Hey, it's like this. As Mark said, I have a new toy. And
yeah, you have a new toy. Yes.
They have a lot of things that they put on here. So we're going to go to the bad news first right now.
Yeah, your sound effects are like Jim Cramer, but you sound a lot smarter than he does.
Yeah, I'm probably
we'll get to him.
That's another story.
Yeah, that's another story. So lots of bad news. If you have been following the public markets, there has been generally a slacking that has been instigated by two factors. One is the AI revolution, which is part hype and part real. And the second part is the spend on that AI revolution. And now there are two things happening. One is the investors in AI are asking for justification of the huge spending. Companies have spent like billions and hundreds of billions of dollars into developing AI models, and they want to see the return. So for example, I was just checking out, OpenAI, which is the company behind ChatGPT, something like a single digit, like 5-6%, don't quote me on that number, like a single digit number of their customers are really paying customers. The rest are just like freeloading. And the whole idea of freemium model is that you take people with the free stuff, bring them in, and then convert them into paid customers. And they haven't been able to do a very good job at that, and which is kind of stunting their revenue growth. So we have two competing forces. One is that AI is eating up other businesses, and the other is the spend is eating up AI. Both of these factors combine for the market basically losing a lot of points on NASDAQ, Dow Jones, whatever you are looking at. On top of that, you have software companies that are likely going to be eaten up, or a lot of their lunch has been, not all of their lunch, but a lot of their lunch has been is going to be eaten up by these AI companies. So these two competing forces have basically meant that a number of stocks that are for small companies, small tech companies, have been hurt, and they fell like 25 to 50%, and that has a downstream effect on the private markets, which is where we are, because there are delays in IPOs now. Whichever company was planning an IPO this year or early this year has to really go back to the drawing board. They haven't officially said anything, but I'm pretty sure that they are right now scratching their head and trying to figure out what they do. And that's kind of the good news. This good news for us is that we can get better valuations when the companies are scared of liquidity. It's like that the old kind of thing is that when things are good, people underestimate risk, and when things are bad, people overestimate risk. So we are at a situation where people are overestimating risk, which means that if we approach this market rationally with a medium-term perspective, we can find relatively good deals in the private markets. Obviously, there are good deals in the public markets also right now, but public markets are just so, once all these non-professional retail investors come into the picture, it can really drive public markets, impact them worse on both sides, whether they're going up or going down. So that's the bad news. Things are down. The good news is, in our world, that means we can drive better deals. So a lot of companies that we had negotiating allocations, we are going to drive better deals in them as a result of the market downturn.
Okay, so is there any great news that are happening? We're actually discussing AI on our other shows, and some of the stats we get is that 95% of the money spent has no return, and that's not pretty good. And it's almost like artificial intelligence is more of a buzzword. Like in the early 2000s, they had what they called .com companies. And I'll never forget, a client came to my office when I was in Seattle. He said, "I'm worth 80 million." I said, "Really?" "Yeah." "Well, what do you own?" And he showed me all these .com URLs. And I went on the internet. The internet was around the early 2000s, did some research, and they weren't real companies. They were kind of like little websites. Well, lo and behold, you know what happened to those companies and those websites? Nothing. I'm serious. It wasn't worth 80 million. What happened to most of those .com companies? They were all gone. I mean, and so when we're looking at AI right now, because I'm trying to get my retirement planning process on an AI platform. But you still need people to do the work. They kept saying it's going to put people out of jobs. I'm going, well, at least from my standpoint, I still need to hire people to do the programming. So is this really going to put people out of jobs, or is it just going to give them a different job? What's your thought?
Yeah. Well, great question. First of all, to the analogy that the .com analogy is really appropriate, because the same thing was happening these days, that you put .ai, you can take Nick.ai and start raising money, and but people would give you $1 million to $5 million just for, saying that you're doing AI. And a lot of this AI is basically building a wrapper around ChatGPT or Gemini. Well, actually, Gemini doesn't allow commercial wrappers, at least the last I checked. It's just building wrappers around other things, and there is really no additional value that you would get, bypassing things. Also, the world is changing so fast that I taught an executive program at Fuqua about a year ago, or a year and a half ago, and knowledge graphs and RAGs, which is like retrieval augmentation graphs. And I think we even had a guest last year talking about RAGs, were the big thing. And lots of companies the companies just got funding for doing RAGs. Literally doing RAGs, and they are out of business now. So there is a lot of hype in AI, but there is also a lot of reality in here. And it is important, like in anything else, to stay balanced through this, because there are two kinds of people, really. One is people who underestimate AI, and the other who overestimate AI. So if you are on either side of that, I would suggest kind of recalibrating expectations and coming down. That's the overall story. Look, ultimately where we are on AI, I would not have imagined 5 years ago that AI would be capable of doing what it can do now. In particular, AI can now ask questions that it needs to know in order to answer your question better. It knows how to investigate better, and I just don't. I couldn't imagine that the technology would be up to this point at this time. So a lot of pure software engineering kind of companies that just have software products with no customers are going to go away, because companies can now build their own software. The companies that are going to stay is the companies that have real customers, that have real business. And it is very similar to what .com did, right? Amazon had a real business. It was Amazon.com, but it had a real business, it had real products, and it survived. But there were so many other companies that had blah, blah, blah.com, blah, blah, blah.com, that was just there. So there's going to be a shakeout. A lot of companies that we hear now would be extinct. And by the way, this is part of like, I grew up in Silicon Valley when Yahoo was the biggest thing in town. I shouldn't say grow up. I mean, professionally grow up. I, professionally developed there. And nobody would ever think that Yahoo would go, be where it is now. Sun was a big thing. In fact, the current Facebook campus was a former Sun campus. And Zuck, for all his faults, did something very interesting. He still has the Sun billboard in the back. And the reason he says that is that it's a reminder for everybody at Facebook that if we don't do our job right, that we will be extinct like Sun is. Sun was swallowed up by Oracle some time ago. In case you were not, some of the audience members probably may not know that's even a company. But it should be a huge company. Most of the best computers that were used in research and even like at universities were made by Sun. So balance is important. From an investor perspective, for a company perspective, evaluate companies based on what their real business is, not just because they are saying AI. Oh, by the way, there are lots of companies that just say AI, even though they don't even have a clue what AI is. I got a pitch deck some time ago that said we use AI-enabled artificial intelligence. So if you think about that, they don't even know what the AI acronym stands for. And they're saying, oh, we use AI-enabled artificial intelligence. That is saying, like, we use ATM-enabled automated tellers machines.
Mm-hmm. Yeah. And there's actually some development in the retirement planning space that they're going to allow tax-deductible VC investments, where people can buy investments that are alternative investments like venture capital. Right now, it's a prohibited transaction, or they don't allow alternative investments like venture capital funds to be purchased by retirement plans. Well, President Trump is pushing to relax the rules. Department of Labor is crafting new rules, so this way people can actually purchase these in their 401ks and their profit sharing plans, and obviously in their pension plans. So I see that coming up. I have not seen any studies how big they think this industry is going to be, because it's relatively new, and we're looking to see more of the developments in that particular area. Now it comes to the artificial intelligence. Are there going to be certain jobs that are going to be immune from artificial intelligence? In other words, like if you get a person coming in to school, are they going to have their jobs basically eliminated because of AI? They even said in the legal area, in the medical area, which we work in, that the medical doctors, the radiologists, the AI is better at, finding cancer than the radiologist is. And then in the legal area, they're having the AI programs are drafting briefs right now. What are your thoughts on that? Are they going to replace the legal community and replace the medical community? Is that what's going to happen?
I wish I knew. I wish I know a lot of things about future that I don't know. What I do know is that AI is getting better and better, and it means that it is making the human beings more efficient. I can tell you, in our life, whenever we are evaluating companies at the top of the funnel, we can actually use AI very effectively to eliminate what we are not going to invest in. But before we put money in, we have to have our expertise and our analysis a little bit deeper than AI is able to give us right now. So where it is definitely going to go is that there are going to be fewer human beings required to do as good or even a better quality job than right now. For example, when it comes to medical field, a doctor cannot scan your entire medical records and try to figure out what's going on. They can't even have it in their head. In fact, I went through several hospital trips with my mother during her last few years of life. And, every time we went to ER, we had an ER attending doctor. They had to look through the medical records, try to figure it out. And, I was actually kind of like their AI because I knew what had happened to my mother before. And I kind of said, here is where you look, and this is what her symptoms look like, and this is what she likely has based on the last time we were here. And then the doctor would kind of do that. Now imagine for a second, like this is kind of a diversion, that if somebody is an old person just living by themselves and they don't have, somebody going with them who has their medical history in mind, they are at a severe disadvantage because an ER doctor cannot quickly scan, especially in an emergency, what is going on. Same thing applies like for any specialist. There's just so much information in medical records that AI can process it faster, and AI can give clues to what this may be, or at least kind of narrow the consideration set. But then a human being is still needed. Fewer human beings are needed, and they can do a better job with AI working for them. I am not, it's not AI is not at the level where you can say it can completely replace human being, especially in medical and financial and actually legal. I would add legal to that because the cost of failure is very high because AI can be wrong these days. Mm-hmm. And AI is getting a little bit better or telling you with what confidence it is right. So I don't know where things are going to be in the next 2 to 3 years, but I imagine that this trajectory would continue up until a certain point. There is a mathematical theorem called Gödel's theorem that actually proves that AI would have a limitation. And I would have to get deeper into mathematics in order to, get, to explain that, but there are going to be limits. So I mean, there's a chat question that AI is used in ticketing and fundraising. Definitely, we are actually looking ourselves right now to look for to see how we can leverage AI in the fundraising part because we haven't done that yet. We have a database of prospective investors, accredited investors, and the question is really which one of these are more likely to invest because we don't want to spam people and lose our reputation. So if we can target. If AI can tell us that these are the 10 people out of the 1,000 that are likely to invest, then we can approach them with a warm email. But it still requires a human contact, ultimately for people to kind of make financial decisions, legal decisions, and medical decisions.
Mm-hmm. Yeah, and also the thing is coming down in the next several years is we've seen Bitcoin. But what is your thoughts on Bitcoin? I mean, I have my own thoughts on Bitcoin. I even have a Bitcoin. Long story how I got one, but what are your thoughts about Bitcoin versus VC investing? Since we broadcast a lot of family offices and investment people, and they're looking at venture capital investments like your opportunity fund or Bitcoin.
Yeah.
What are your thoughts between Bitcoin and VC investing?
Well, to channel my inner Warren Buffett, Bitcoin is not an investment. Because it doesn't produce anything. It is a currency. So for me, Bitcoin is just like US dollar. Is the US dollar going to be stronger or weaker in the future? I do not know that. If I am kind of like a macroeconomist and stuff, I may have better, knowledge than everybody else. But right now, most of the Bitcoin traders are really technical traders. They look for technical patterns and stuff. And those technical patterns have been learned on systems before a lot of electronic trading was around. So I would imagine that, investing in Bitcoin is, right now, people who aren't in Bitcoin are probably are really nervous. And the people who are not in Bitcoin are also really nervous getting on because, it's like almost a free fall right now. I think it was like 67,000 or something like that earlier. This week or today or something like that. I saw a headline, but ultimately it's a currency, right? I feel that blockchain is much more than a currency, and people miss out on that. The whole idea of blockchain is that it can maintain a system of verified record. And, for example, in legal contract, it can have a legal contract that is really verified and cannot be changed. I had one situation where one of my former employees took me to small claims court, and they doctored the contract that I had with them, and the judge couldn't tell which contract is original and which one isn't, because apparently they had a different copy which they were able to edit in PDF and so on. So this is the small claims court didn't have the time to kind of go and do any research. So if you use blockchain for verification, you can like have, okay, this is the valid legal contract and this is the forgery. Cryptocurrency is a currency ultimately, and it's a currency just like US dollar or Chinese yuan or whatever you want to call it. And your guess is as good as mine where it's going to go, unless you have some inside information that I don't.
Okay, no, I don't have inside information on this, but another question I have, because when you're looking at companies, and I said we looked at, well, even Sun Microsystem actually did a lot of work for the third leading reseller of Sun in Boston, believe it or not. And the thing is, he was my client. I don't know what he's doing now since Sun's gone, but things keep changing, and there's a game called Survivor. In other words, and we've seen that in the .com area, we've seen that in the tech area. How do you tell when you're looking at companies which one is going to be the survivor? Because remember, there was WordPerfect. People don't remember it. I do. That we thought was the dominant player in the market, and then WordPerfect got eaten up by Microsoft Word, and then we're stuck with unfortunately not as good as a program, an inferior program because of that. So when you're looking at these companies to invest in, how do you know who's going to be the survivor and who's going to be the dead man walking?
Well, the short answer is that I don't, but I can have a fairly good idea of what the probabilities are, of what the survivor, who is going to be the survivor. And talking about WordPerfect, you probably are old enough to remember Lotus 123 used to be like the spreadsheet of choice. There are a couple of things at play here. So one in the VC business, we call it the power law. And the power law basically is that we are willing to bet on a company that dies, because if we, let's say, bet 100,000 on a company and it dies, we lose only 100,000. But if we bet 100,000 on a company that gives us 100x return, all of a sudden we have money coming out of our ears. So typically what we do is we kind of do a probabilistic analysis, and the market that I'm in right now, which is the secondary market, the probabilistic analysis basically says that we want an expected return of 2x in 1 year. So we want to double our money in 1 year, triple our money in 2 years, quadruple our money in 3 years, and quintuple our money in 4 years. And as long as that is the expected value, we will bet on that company. And where we are right now, it is very hard for any of our bets to go out of business because we are investing in businesses that are pre-exit. In other words, they are ripe for IPO, they are ripe for acquisition, and they are going to survive. So we are not going to lose our money. Actually, there's no such thing as never going to lose our money, but we are very unlikely to lose our money. Now, there is the other side of people, which is the early stage investors. The early stage investors would invest in Nick.ai or Salman.ai or Mark.ai and say, okay, we are going to put our money into these companies, and we'll probably put in like 25,000-50,000 each, and we'll see where it goes. Now, those people are in real trouble because they have not done any probabilistic analysis. In fact, I don't know if I ever shared this publicly. My at least on this show, I've shared this with people in calls and stuff, that I started investing semi-professionally or amateurly in 2001 when the dot-com bubble crashed and or burst, and there were a lot of good deals and good valuations in the market, but I didn't do very well. And the reason I didn't do very well is because I wasn't doing that probabilistic analysis of what is my expected return, and that's basically what needs to be done. So one of the companies that I invested in, I got in at 35 cents per share or something like that on the average cost. The company went public at $35, went up to $80. I got roughly 171x on my return, and I still retained quarter of my position. And that stock has come down from 80 a few years ago to about 7 something this week. So, and even if that goes to zero, I still get 171x return. Now, when I invested in that company, my expected value was 10x, that I'm going to get 10 times my money back in about 5 years or so. And it superseded my expectation. There was another company that I invested in, which was replacing what which was doing what Google Wallet and Apple Pay do now, but it was ahead of its time. And at that time, most of the checkout counters and credit card machines were not capable of tap to pay. And that company went out of business simply because it was ahead of its time, and it cost like hundreds of dollars per terminal for companies to replace it. In fact, Walmart still has those old terminals where you can't tap to pay. So they weren't able to capture the market fast enough because it required major investment on part of the retailers in order to get that tap to pay. So, my expected return on that was 10x as well, but I got 0x. But I'm a happy person. I would rather have 171x and 0x than have 1x.
Yeah. So true. Now,
yeah.
A question that does come up quite often, and it comes up in a lot of businesses. As a matter of fact, I had to go through the exercise this weekend with my business partner, and something you discussed is company valuations. Now, he took our financials, ran through several computer programs, and came up with these magic numbers, valuations. But my question to you, Dr. Zar, is how do you do company valuations, especially on closely held businesses? How do you come up with these numbers?
Yeah, so what we use is comparative company analysis. It's CCA, and I don't think it's taught in most business schools. But what we look at is comparable companies that are public. So, for example, we have a company, Quesky, which is fintech. It has buy now, pay later, and it has also like micro loans on its platform. It's very similar to Affirm, Klarna, SoFi. We know what SoFi's financials look like. We know what the multiples we can infer from that. And then we take like a weighted average of these multiples and apply them to value this company based on its financials. And that's how we do it. Now, in MBA, they talk about discounted cash flow, which is kind of like, in our business, it's a joke because we generally invest in companies before they have a positive cash flow. So if you were trying to use discounted cash flow, we would actually come up with a negative number for that. But and there are some kind of rules that have come up. There's a rule of 40 where basically it says that your growth plus your EBITDA should be more than 40%. In other words, if you're growing at 100% or you're doubling your business and your margins are negative 50%, your rule of 40 is still saying that, you have 50 and you're doing fine. So we have also those criteria that a company has to check off in order for us to invest. Now, when it comes to like cash flow positive businesses, like your pension fund, for example, or your that is the MBA. I don't do that, by the way. Basically, you use discounted cash flow, and discounted cash flow basically says that whatever money you're making now, whatever you make in year needs to be discounted based on the time value of money, and the next year and the next year and next year. So that's how there are lots of questions, by the way, on the chat today. So I did not invest in Friendster, but I know the founder of Friendster. Again, what was that company that that was competing with Facebook's MySpace? Yeah, MySpace that Facebook ate up. Nobody could have kind of expected that. And then nonprofits, AI and nonprofits. I think that's a very right kind of thing because nonprofits are less concerned about the financials and more concerned about the impact. And even though they have to do a lot of fundraising. That's the case. Movie theater, I'm just going to do like rapid fire on this. Movie theater business, I actually disinvested. I actually sold it short because I saw things coming with Netflix, where people can do that. And I saw that in my own habits as well, is that I can, watch a movie in the comfort of my home. I can actually have a mini theater and that is a better long-term investment. And I don't have to go anywhere. I can even invite my friends and family. And, for $10-20, 20 of us can watch the same movie and have much better comfortable seating and not sit in chairs where I don't know what has happened before and who has done what in those chairs. And I don't want your imagination to run too wild. No, nothing in multi-level. I think multi-level still exists. I'm not a big believer on that because ultimately they are really, it's a pyramid scheme, and it seems almost like a Ponzi kind of scheme to me. And by the time a consumer gets the product, there are just so many people that have picked. So unless you're at the top of that pyramid, you would have trouble retaining people.
Yeah. Well, we talked about the IPO market being soft, but there's another market that's emerging, and they've actually bought several major insurance companies we work with. It's called private equity. As a matter of why I say major, I'm talking about 40, $50 billion insurance companies have been purchased with private equity. Are you seeing private equity muscle in over the IPO market, where private equity becomes a major player as opposed to IPOs in terms of an exit strategy? What are your thoughts on that?
Yeah, so the private equity business is actually impacting the VC business quite a bit, because they are extending these large checks to these companies at late stage, companies that we want to exit and get our money back, but now they have given them kind of a more extended runway. So for example, one of my investments is Dataminr, and they not only give Dataminr millions or hundreds of millions of dollars, but they give the founders and employees about $25 million. So they are not motivated to exit anymore, which delayed the exit and delayed our money coming back. And that's not just us, that's generally happening in the VC industry. So VCs have a cash crunch now. They have a liquidity crunch, which is actually, again, good for our business, because we are actually buying from these VCs, and the more of a cash crunch they have, the more desperate they are to sell, and the better value we can get.
Yeah, and we're desperate to get out of here because we're past our time, but we do want to thank Dr. Salman Azar, who's the head of the and also a professor at Duke University, and our viewership in the United States, but also don't discount our viewership around the world. And we'll see you next time on VC Masters, only on the Pod TV network. I was going to say the IPO network, but we're not.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like